A lot of people talk about real estate and stocks like you have to pick a side, team property or team stocks. And usually the people on each side sound very sure of themselves. Real estate people will tell you property is real, safe, and powerful because tenants help pay it off. Stock people will tell you stocks are easier, more liquid, and way less stressful. And both sides say the same thing in different words. This is how people get rich. So, which one is actually better, real estate or stocks? The real answer is more interesting than most people think because this is not just about returns. It is about how wealth is built, how risk behaves, how much time you want to spend, how much flexibility you want to keep, and what kind of rich you are actually trying to become. So, in this video, I want to answer the question properly, not in a tribal way, in a useful way. Because both real estate and stocks can build serious wealth, but they do it differently. And the wrong choice for your personality can cost you years. Let's start with the thing most people care about first, returns. Over long periods, stocks have delivered strong returns, and publicly traded real estate through real estate investment trusts has also delivered competitive long-term returns. So if you came here hoping for a simple line like stocks crush real estate or real estate always wins, that is not really how this works. Both can work. The bigger question is how they work. Stocks are usually easier to start. That is one of their biggest advantages. You do not need a huge deposit. You do not need tenants. You do not need repairs. You do not need to deal with agents, transfer costs, inspections, or property drama. You can start small. You can automate it. You can diversify fast. That last point matters a lot. That means with stocks, especially through broad index funds, you can own tiny pieces of many businesses at once. That lowers single asset risk. With one rental property, your money is concentrated. One house, one area, one market, one tenant problem, one maintenance surprise, one long vacancy. That concentration can work well when things go right. But when things go wrong, it can hurt more than people admit. Now let's talk about the thing real estate people love most, leverage. This is where real estate gets powerful. With property, you can control a large asset with a fraction of the purchase price up front. That is not how most people invest in stocks. And this is one of the main reasons real estate can create wealth fast. If you buy well, use debt carefully, keep costs under control, and the property appreciates while a tenant helps cover the mortgage, your returns on your own cash can look very strong. That is real. But leverage is also why real estate can go from wealth builder to stress machine. Because leverage magnifies outcomes. It does not only magnify wins, it magnifies mistakes too. Bad location, magnified. High vacancy, magnified. Big repair, magnified. Wrong numbers, magnified. So when people say real estate made them rich, that can absolutely be true. But what they often leave out is that leverage did a lot of the lifting. And leverage demands skill, margin, and emotional control. Now, compare that with stocks. Stocks are more passive for most people. You buy, you hold, you add consistently. And if you use diversified funds, you are not managing roofs, plumbing, tenants, or legal issues. That simplicity is not boring. It is a serious advantage, especially for people who have demanding jobs, low tolerance for admin, or no interest in becoming part-time property managers. And there is another huge difference. Liquidity. Stocks are much more liquid than direct real estate. You can usually sell part of a stock portfolio quickly. You cannot sell one bedroom of your rental house. You cannot easily sell 12% of your property to cover a short-term cash need. Real estate is lumpy. Stocks are flexible. That flexibility matters more than people think because wealth is not just about growing money. It is also about how trapped your money is. Now let's talk about effort. This is where the debate becomes clearer. Direct real estate is usually more active. Even if you hire help, there is still more friction, more paperwork, more decision making, more maintenance, more surprises. Stocks, especially passive investing, usually require much less from you. That means if two assets can both build wealth, but one takes far less time and mental energy, that difference matters, especially if your main goal is not to become a real estate operator. This is why I think a lot of people ask the wrong question. They ask, which one has better returns? The better question is, which one fits the way I actually live? Because if you hate complexity, hate debt, hate managing people, and hate dealing with physical assets, then direct real estate may be a terrible fit, even if the upside looks attractive. And if you want something hands on, want to use leverage, understand local markets well, and do not mind more moving parts, then real estate may suit you much better. Now, here is the part that confuses a lot of people. Real estate often feels safer because it is physical. You can see it, touch it, stand inside it. That makes people feel secure. Stocks feel abstract by comparison, but feel safer is not the same as is safer. Stocks move around more on a screen. That volatility scares people. Real estate looks calmer because prices are not quoted every second. But that does not mean the risk is gone. It just means the pricing is less visible. Both carry risks. Real estate has financing risk, concentration risk, maintenance risk, tenant risk, regulatory risk, and liquidity risk. Stocks have market risk, emotional volatility, and the risk that people panic and sell at the wrong time. So which one makes people rich more reliably? My honest answer is this. For the average person, stocks are probably the easier path to wealth, not because they are more exciting, because they are easier to do consistently. They are easier to automate, easier to diversify, easier to scale, and easier to hold without your life turning into admin. That matters a lot because the best investment is not just the one with a good spreadsheet. It is the one you can stick with for a long time. Now, can real estate outperform stocks for some people? Absolutely, especially if they buy well, use leverage intelligently, manage risk tightly, and stay disciplined. But that usually comes with more skill, more work, and more concentration. So if someone says real estate made me rich, I believe them. But I also want to know, how much debt did you use? How much work did you do? How concentrated were you? How much stress did you carry? Because those details matter. Now, let me make this even simpler. Choose stocks first if you want. Easy entry, low friction, diversification, liquidity, and a more passive path. Choose real estate first if you want. Hands-on control, the ability to use leverage, and you are comfortable with more complexity and less liquidity. And for a lot of people, the smartest answer is not either or. It is both over time. You might build your base with stocks first because they are simpler and easier to automate. Then later, if you want, add real estate once your cash flow, knowledge, and margin are stronger. That is a much smarter approach than forcing yourself into one camp. Here is my bottom line. If you are asking which one will make you rich, the answer is either one can. But stocks are usually the cleaner path. Real estate is usually the more hands-on, leverage path. So the winner is not just about the asset, it is about the investor. Your temperament, your skill, your patience, your need for flexibility, and your willingness to deal with friction. That is the real answer. And honestly, that answer is more useful than a fake one-sided debate. Now watch the next video about America's most dangerous money traps.